Welcome back to the Property Pulse podcast. Today, we're very privileged to welcome Simon Cooper, with a career devoted to helping clients navigate the complexities of financial planning and property within a self-managed super fund. Simon brings a wealth of knowledge and experience to the table. His passion for logical advice and commitment to safeguarding and growing family wealth, making him an invaluable resource in the realm of self-managed super fund investment. Join us today as we explore Simon's insights and expertise in unlocking the potential of property within your self-managed super fund. Let's get started.
Welcome to the Property Pulse podcast, your prime source for Southeast Queensland real estate insights. Understand the latest property data in Queensland to grow your net worth, as Geoff Tomkins interviews industry experts to give you the latest market updates.
Today, I'm very excited to introduce you to Simon Cooper, the founder of SMSF Wealth and a fully licensed financial planner, a leading authority in SMS investment strategies and wealth management. Simon is here to share his invaluable insights into the world of self-managed super funds, more importantly, property within that self-managed super fund. Welcome along, Simon.
Hi, Geoff. Hi, everyone. And thanks, Geoff, for inviting me today, and looking forward to answering your questions.
Just before we get underway, I just would like to add a general disclaimer. The advice we give today is of general in nature. It does not take into account your specific needs or financial position. So you should always look at your own financial position before making any property decisions. So I've invited Simon along for a number of reasons. We recently did a webinar together. And I'm seeing a lot more clients looking to put their properties into the self-managed super funds. Many are first-time property investors within the self-managed super funds. And as it works very differently, I thought it was really important that we have Simon along. We recently did a webinar, as I mentioned, and the insights and information that Simon provided was invaluable. So thank you again for coming along today, Simon, and we'll just jump straight into the questions.
Yeah, no, once again, Geoff, thanks for having me, and looking forward to answering the questions that you've got.
Okay, so probably one of the most first questions people ask is, how much do I need in my self-managed super fund to buy a residential property? Now, I wouldn't know, it varies. There's a few factors, but as a general rule of thumb, what's the sort of range, Simon?
Yeah, great question, Geoff. Look, always sort of go back to the ATO. They recommend to have at least 250 to 300,000 as a minimum to purchase property. However, it really comes back to having enough of a deposit to obviously cover that and the initial costs. I know that we'll probably cover this off a bit later, but lenders will lend up to 70% of the property purchase. So, if it's $1 million property, you're going to need at least 300,000 plus to obviously cover that.
Great, fantastic. Now, if they don't have that minimum sort of 250,000 generally recommended, can they make a loan from their personal assets into the super fund to boost up that figure?
Yeah, definitely. Look, there's a couple of different ways you can go about that, Geoff. Yes, they've got related party loans, and obviously depending on the person's circumstances, we'll sort of go through that in more detail. Probably one of the better options, though, is to look at what people's contribution to super options are. So there's certain super contributions that can be made, especially any unused concessional contributions, where someone can offset their taxable income or any capital gains tax that's due, obviously reduce their taxable income or tax payable, and then be able to boost up their super. The other thing to bear in mind is with self-managed super funds, legislation's been changed in recent years where you can actually have up to 6 members now. So It could be an option of looking at your family, maybe adult children, definitely combining with your spouse if that's an option, and being able to boost up those funds within your super to then build that property portfolio there.
Yeah, I think that's a great option, and it really opens the space up for people looking to invest in real estate if they can't buy outside of the super fund. Being able to combine those resources with up to 6 members, it definitely gives more families an ability to, I guess, to do it jointly together, which is a great way to build your, your property wealth.
Yeah, definitely, Geoff. And look, it doesn't have to be family members either. You can go in to a self-managed super fund with business partners and friends, obviously people that you'd have a close relationship with. You can either segregate or pool those resources. So a few different options, but look, everyone's different in their own circumstances. So it's sort of looking at someone's personal situation and looking at what's going to be the best option.
Fantastic, thank you. So I know with a property within a self-managed super fund does work a bit differently to a property outside, and there are some restrictions. What are some of the main restrictions, Simon, about a property in a self-managed super fund?
Yeah, great question, Geoff. Couple of points there. One, you can't buy a property that you aim to live at while it's in your self-managed super fund. So you can't live in the house. You can't rent it out to family or relatives either. It has to be an investment property that you've rented out to with a commercial lease or a residential lease, but just the same as what it would normally be with a real estate agent. So having that normal commercial arrangement in place. You can't make significant changes to the property once it's purchased. So as far as major renovations, so it needs to be an existing property. Also, you need to, like I touched on, have enough as a deposit for the loan. You can't, in most cases, you can't transfer existing property into your self-managed super fund unless it's a commercial property and it's your place of business.
Right. And I know we had a question on the webinar the other night about being able to develop or subdivide properties within a self-managed super fund, which you mentioned that that's not able to be done in a super fund.
Well, that particular question, Geoff, was my understanding was someone had already purchased an existing property through a bare trust structure, which is the way it works when you borrow to buy property. And then they wanted to then subdivide that existing property they already had in super. So that's something that you definitely can't do. It breaches super laws. There are a couple of different strategies that we have worked in the past where your self-managed super fund can go into a joint venture to do a development. But that's, once again, it really comes back to people's certain circumstances and how that would best look.
Fantastic. Now, another common question we get asked with property in a self-managed super fund, can we borrow within the self-managed super fund to buy a residential property? And what's sort of the banks willing to lend in the super fund?
Yeah, another great question, Geoff, and I know I touched on it a little bit already, but you definitely can borrow. It's a bit of a different structure. So you've got your self-managed super fund, and then you have what's called a bare trust, and that has its own separate corporate trustee. And then the bare trust will then borrow the money to purchase that property, and it will lend up to 70% of the purchase price. So you need a lot higher deposit than what you would in your normal name, but the borrowing is separate to your personal lending side of things too. So
right, and I think that's a really important factor, Simon. A lot of people are building their property pool base or assets outside of super, and a lot of people are capped out with their borrowing capacity outside of super. This option gives them the ability to keep building their property portfolio.
Yeah, 100%. So, if you've sort of got to your capacity as a property investor outside of super, you may have a couple of properties there, and it's a great way to be able to continue on that journey of building that portfolio, and then with that have in a couple of years' time, your personal lending situation might be better, so you can then be purchasing through your own name as well. So it can be that that journey of being able to utilise both avenues to get to those property portfolio goals a lot quicker.
Fantastic. Now, I know one of the other big benefits of a property and self-managed super fund is the ability the property sort of stand alone. It takes care of all the income and expenses within the super fund. Yes. Can you just briefly, please explain how that sort of all works, Simon?
Yeah, 100%. So with that, as a general overview, obviously the rent will be paid into the self-managed super fund. The self-managed super fund then takes care of all the loan repayments, takes care of all the property maintenance repayments, and any costs associated with that investment property is all within that self-managed super fund structure. So, once again, you're not having any of those out-of-pocket expenses. One thing to obviously bear in mind is if it's a negatively geared property, you need to be able to have sufficient resources, which could be through way of super fund contributions, to be able to cover that shortfall. However, in saying that, Geoff, I know that you specialise more in the the high cash flow properties, so that, with that sort of things, if they're cash positive, then it doesn't tend to be a problem.
Great. Now, just confirming that was a good point you mentioned, Simon, was just confirming that the client's super contributions from their employer can go straight into their self-managed super fund as well to help boost up the income or pay off the loan or debt?
Yeah, 100%. So you've got your employer contributions. Now, depending on how much your employer is contributing into your super, there's different concessional contribution caps. So previously it's been at 27,500 each financial year that both you and your partner can be making into your super. As of this coming financial year, that goes up to 30,000 a year each. So depending on how much your employer's putting in, and depending on obviously what your personal circumstances look like, you can be contributing up to that figure. And the extra contributions, it's also known as salary sacrificing, will offset your taxable income and tax payable.
Okay, great. And you touched on a great point there. I'd like just to clarify the tax benefits, because I know within a super fund there's some real incentives to put extra money into your super fund, and it's a very tax effective environment. Can you just clarify the tax rate on that ability?
Yeah, definitely, Geoff. So with your super fund, you pay 15% tax on all income or profits made through your self-managed super fund. When you're eligible to go into pension phase, you pay 0% tax on those profits.
Wow.
In Australia, people are eligible from age 60 to go across into pension phase, provided that they've retired from full-time work. However, with the right forward planning, there are different strategies that we can utilise where, like if you're a business owner or if you've got a couple of different jobs, you can just retire from one, still be working. On paper, you're retired, but you still can be working. So different circumstances for different people, but with the right forward planning from age 60, you can be eligible to go into pension phase. And like I said, 0% tax on those profits.
That's fantastic. And I think there's real incentives there. Like, many employees are paying, up to 33 cents, up to 48 cents in the dollar. So being able to contribute into your super fund at 15 cents, that's the game changer for a lot of people, being able to really build that asset in a very tax effective environment. And I think that's why we're seeing more and more clients approaching us about putting property in their self-managed super funds. They take control of the asset. They know where their super's invested. And also they see that asset, they can pay that loan down by making those contributions at 15 cents in the dollar. Fantastic. So I can see why a lot of people are going down this path, and we're getting a lot of interest from property in self-managed super funds. Now, I know it's not a simple process to set up a self-managed super fund. I know it's very heavily regulated, which it needs to be because it is our super. So can you just touch on some of the major requirements for auditing and et cetera in terms of a self-managed super fund, just so clients are aware of, it's not a simple, easy, cheap fix. You do have to make sure that everything's done properly and compliant with the ATO.
Yeah, definitely. Yeah, look, there are a number of different factors when it comes to having a self-managed super fund. And ultimately, as the director of it, so normally the way it works, or the way it best works, you've got your self-managed super fund, and then above that, you've got a corporate trustee. Okay, a corporate trustee provides a lot more protection than just being an individual trustee. And then you would be a director of that corporate trustee. So as a director of the corporate trustee, and the trustee is there to be able to look after the assets and take care of the assets in the self-managed super fund for its members, you as an individual are responsible for making sure that that self-managed super fund is compliant ongoing. However, there are various professionals like ourselves that can be doing that work for you. So just a couple of things. Every year, there needs to be a yearly tax return and audit completed on self-managed super fund. And that tax return is separate to your own personal tax return. Every year, the investment strategy of your self-managed super fund needs to be reviewed and adjusted. Insurance needs to be considered every year for the members in the self-managed super fund. There may be some changes to estate planning needs for the members of the self-managed super fund. And look, the self-managed super funds that we put in place, we do a will with testamentary trust. as opposed to your typical binding death benefit nominations. If you have property in a self-managed super fund, you need to have an actuary certificate done every year, which is all tied into the audit. And also with that, just making sure that it's running properly as well. So look, there's various professionals. We obviously look after clients with getting it all set up, making sure it is compliant ongoing. And at the end of the day, it just takes away the hassle and just being able to utilise it as a great way to build wealth.
Yeah, great. And I think that's, the detail that you need to go into for a self-managed fund. It's very important to have a good professional financial planner, statement of advice, all those other protection in place to make sure that you are compliant, because yes. I know there's quite big penalties if you breach those compliancy rules, and also being, changes to the tax laws and super fund laws ongoing. You need to be on top of that. So probably leads into the next question, which is one of the other more common questions we get asked. I know there's quite a bit of work to set up a self-managed super fund. You set up trusts. You have to do your rollovers from your current supers into your self-managed super fund, statement of advice. All the setup is quite detailed to set up. So what's the average cost or range, Simon, from where to go to setting up a self-managed super fund with a bare trust ready to buy that property in there? Just as a sort of general sort of guide range, please.
Yeah, great question, Geoff. And we get that a lot as well. So look, it does vary from individual to individual, but I guess to give you a bit of a range, getting everything set up to purchase a property through your super can range anywhere from $10,000 to $15,000 as a one-off amount. And like I said, depending on what your circumstances are. With that, though, if you're spreading that across a number of people, that does reduce that down. But also, too, those costs can actually be charged to your super. So There's a few different options there. But yeah, look, that's the general range that we look at.
Fantastic. And when you look at the property price growth that we're seeing in Australia, right around Australia at the moment, those costs are pretty insignificant. You're going to gain those back fairly quickly. And the other benefit is the property is in a trust, so it's very safe. It's separate to your other assets, I believe. Is that correct, Simon?
100%. So within super, everything is protected against bankruptcy and whatnot. So you have a lot more security than if you were purchasing property through your own name.
Fantastic. Well, thank you very much today, Simon. It's been great insights there, very valuable, an expert. I know we've known each other for a number of years now and worked together, so great to have you on. Thank you for putting your time, and I hope it's given our viewers some insight into how a self-managed super fund works.
Not a problem, Geoff. Thanks for having me again, and look forward to catching up again soon.
Thank you. Well, thank you everyone for joining us today. I think it was a great insights from Simon. As I mentioned in the podcast, we recently did a webinar together. We actually had quite a lot of detailed slides. So if you'd like to see a copy of the webinar, which goes into a lot more detail about the cash flow and how it all works, please just reach out and we can share that. So if you've enjoyed the podcast and got some valuable insights, please share this episode. We'd love you to leave us a review, as it really helps others to find our podcast and benefit from the content that we are continuing to provide. Remember to hit the subscribe button to keep up to date with the latest episodes. And if you'd like to make contact with Simon or myself, our details will be in the show notes. See you next time.